Every IRS exam ends in one of three closures. No change means you substantiated everything, and the IRS accepts the return as filed. Agreed means the IRS proposes changes and you sign off, so the assessment happens. Unagreed means the IRS proposes changes. You understand them, but you don't agree. So you shift from exam mode into dispute path mode. On the EA exam, they love testing which path matches each closure type. No change can happen even without a face-to-face meeting. Think mail audits where you send proof and the IRS closes it, like a taxpayer substantiating residency and disability for a qualifying child, or responding to a CP 2000 by proving the W-2 is identity theft and filing Form 14039. Exam tip: no change doesn't mean no questions asked. It means the taxpayer answered the questions well enough to win. Agreed versus unagreed is about consent. In an agreed case, the taxpayer signs the agreement and the IRS assesses the proposed tax, penalties, and interest. In an unagreed case, the taxpayer doesn't sign, and now you look for the next step. Ask for an examiner's manager conference, consider fast-track mediation, or go to appeals. The exam likes to test that fast-track mediation doesn't require a written protest. Here's the big picture of dispute paths. If you're still in examination, you can request a manager conference to try to resolve it early. Fast-track mediation is designed to settle faster, and again, no written protest is required just to request it. If it's not resolved, you go to IRS appeals. If you still can't settle, the IRS issues a statutory notice of deficiency, the famous 90-day letter, which is your ticket to tax court without paying first. Once an exam is closed, the IRS generally won't reopen it just to assess more tax. But there are three classic exceptions you must memorize: fraud or misrepresentation, a substantial error based on an established IRS position at the time, or a serious administrative omission if the case stays closed. On the EA exam, reopen questions usually hide one of those three triggers in the facts. Audit reconsideration is different from reopening. It's a taxpayer request to reevaluate a prior audit result when additional tax was assessed and remains unpaid, or a credit was reversed or denied. The key is new information with documentation that wasn't considered before, like finding missing receipts after the audit. It can also apply if the IRS made a computational or processing error, or if the taxpayer later files a return after the IRS did a substitute for return. One more protection: repeat examination discontinuance. If the IRS audited the same items in each of the prior 2 years and proposed no change both times, the taxpayer can request the current exam be discontinued. It's not automatic, but it's a strong argument when the issue is identical, like recurring large charitable contributions that were substantiated twice already. This is a favorite procedural rights fact pattern on exams. Finally, partnerships. The Centralized Partnership Audit Regime, or CPAR, generally audits and collects tax at the partnership level. It's mandatory unless the partnership elects out on a timely filed Form 1065, Schedule B2. To elect out, you need 100 or fewer partners, and only eligible partners, like individuals, C-Corp, S-Corp, and estates of deceased partners. Trusts, disregarded entities, and bankruptcy estates can blow the opt-out. A statutory notice of deficiency is also known as a 90-day letter because of what 90-day deadline? Is it the deadline to petition the U.S. Tax Court, to protest to TIGTA, to request a collection appeals hearing, or to file a protest with IRS appeals? Think about what the notice of deficiency actually unlocks for the taxpayer. The correct answer is, the taxpayer generally has 90 days from the date of the letter to file a petition with the U.S. Tax Court. That's why it's called the 90-day letter, 150 days if addressed outside the U.S. A tempting wrong answer is filing with IRS appeals, but appeals is typically before the statutory notice, not the reason the letter is famous. If a taxpayer and the IRS fail to settle a non-docketed examination controversy in the IRS appeals office, what happens next? Do you get a notice and demand for payment, a referral to the taxpayer advocate, a notice of deficiency, Or does the case go back to the revenue agent? Think about the step that formally sets up court rights. The correct answer is issuance of a notice of deficiency. If appeals can't settle a non-docketed exam case, the IRS issues the statutory notice, the 90-day letter, so the taxpayer can petition tax court. Notice and demand is a collection step after assessment, so it's tempting, but you're not there yet if the next move is the deficiency notice.